Welcome to today's episode of Peak Market Watch. We speak with market leaders in commercial real estate and related services who have a close pulse on the current market environment. My name is Anton Mattli, co-founder and CEO of Peak Financing. I'm honored to welcome Sandra Taylor, owner and principal of SL Investments. She's also the president of the board of directors of Crew Dallas, which is the leading organization for executive women in commercial real estate. Welcome, Sandra. It's a pleasure to have you with us today.
Thank you, Anton. It's a pleasure to be here.
Yeah, so why don't you tell our listeners a little bit about your background? And obviously, we also want to hear a little bit more about Crew.
Absolutely, absolutely. I think I fell into commercial real estate many, many years ago as I was doing some bookkeeping work and fell into a position at Grubb and Ellis, which is, I don't even think exists anymore. But I remember my boss said to me, "You're sitting on the wrong side of the desk." And I didn't know what that meant. But what he saw in me was that I'd be a better professional uh, commercial real estate professional if I was out talking to tenants and working with landlords instead of sitting and doing an accounting processes and procedures for our owners. So that began my journey, and that was many, many years ago, and rolled into portfolio management and then commercial property management, asset management, construction management, and currently, I am the owner of my second commercial real estate company, and I work and live here in Dallas, Texas.
Very good. Uh, I think you underplay a little bit your asset management experience, right? You worked for Prudential, right,
Yes,
asset resources. So we do not just talk about a few assets; we talk about billions of of assets in a portfolio.
yes, yes. What brought me to Dallas was an opportunity to work for Prudential Asset Management, which is now PGIM. And I was placed in an FHA asset manager position and given a portfolio of multifamily hospitals and senior living. Within my couple of years of working there, they had given me one of the largest loans on their books, which was a large hospital in New York City. And it was a great opportunity to refresh and renew some underwriting skills, but it was also a great opportunity to understand agency lending and its tool to the commercial real estate world, and its ability to leverage more of the asset if your long-term strategy was to hold on to your assets. So after having worked there a while, then I rolled into having my own multifamily investment company and have used some of the agency products in the past, again, depending on the strategy of the hold of the asset. So the breadth of asset management spans from day-to-day property management, oversight of accounting, construction management, tenant and landlord relations, being in charge of large scale and small scale redevelopment projects, and having the fun of working with commercial real estate contractors and architects and engineers. So it really has expanded into, I get to touch all the different areas of commercial real estate, which I really enjoy. That's the fun part of what I do.
Very good. So your own investments that you have been focusing on, were they all multifamily?
Yes, our strategy that we came up with began with a value add proposition, and that was in early 2016. And we started with a couple acquisitions of single family homes, and then rolled into a duplex, then an eightplex, and then we jumped to a 67 unit complex. So to date, we've sold everything that we had in our portfolio in mid 2022, but the strategy switched along the line from value add to core plus, and opportunistic. And we very much focused on the infill markets of Dallas and B and C grade properties. So some of these assets are small, some of them are large. And they all had a component of could be improved. And they also had a component of what I call NOAA, and maybe you're familiar with that term, but it's called natural occurring affordable housing. So there's no tax credits, there's no supplemental income requirements, it's not Section 8, it's just people working day to day, having a place to live that's clean and as safe as we could make it. A lot of times these properties do not come with a lot of amenities. We were lucky enough to have some with pools, some without pools, but they don't come with the Amazon lockers and the on-site full-time staff. They do come with 24-hour maintenance, but it just doesn't have all the amenities that a Class A would have.
Sure, right. So I think another term that is often used for it is workforce housing, right?
Yes,
Again, it's not that there are any tax credits or any Section 8s or anything else. It's just that compared to the Class A's and even the Class B properties, they tend to be more affordable by today's standards, right?
yes, yes,
Rents
exactly.
tended to be below $1,000 for most apartments, and now they're well for most apartment sizes are well above $1,000 per unit.
Yes,
Uh, so it's obviously a very important role all these properties play in the marketplace, particularly today where affordable housing is so difficult to come by. And it's also important that all these tenants residents get housing that is safe and is clean, right? So not all C-class properties are the same. There are definitely
right.
some landlords that are uh, uh, not maintaining these properties to the right standards and make the properties not only unsafe but also just not very pleasant to live in. Uh, and that's not what you're doing, right? So you're providing
No,
a safe.
no. We try to provide housing near economic drivers. So one of the assets that we owned was near a hospital, which has a very large employment base, and that's the key. If you can get them close to where people work, it's convenient for them, and there's not a lot of those opportunities in the affordable category within these infill markets. You can find them sometimes if you go out further, but sometimes people have to walk to work. Sometimes they take the bus. And so having them near the place of their employment is a big bonus. So yes, that's what we do. We go in and we try to find available properties or sellers that are willing to sell near some of these economic drivers. And that has proven to be successful in some cases, and then difficult in others because it is a very popular market. A lot of developers want to come in and buy it and rebuild it with a Class A, which sometimes that's just as appropriate as keeping it as workforce housing.
Yes, obviously it's attractive for a developer when they can pull it off. The problem is it removes even more affordable housing from the marketplace, right?
Yes,
Yeah.
yes, and it's very difficult to build affordable housing because you have your land costs, you have your normal construction costs. Even if you don't put high-end appliances and high-end finishes in them, it's still very costly to build workforce housing. And there are new requirements and components of it that are imposed by our local, state, and federal government that can make it more difficult to maneuver through to get the correct tenant base.
Yep, absolutely. Right. And that's the reason
Hmm.
why virtually all new construction is Class A, right?
Yes,
Uh,
exactly.
because the construction cost is just too high to support any type of affordable housing. It's
Right.
unfortunate, but that's just the way it is, right? Uh, so your recent acquisition, if naturally, and you talked about 2016 when you started the process in earnest. It was a very different market environment. I would say there was a lot of velocity in the marketplace. There were a lot of properties that were for sale, and you could buy easy a property. Obviously, we're always competing with other buyers, but at least there was a lot of volume that was transacting every single year. Over the last year, once or 2 years, once interest rates moved up, the situation changed greatly, and it was much more difficult to find properties that sellers were willing to sell, right? Because cap rates moved up,
Absolutely. Yes.
and obviously there has been a pretty steep price gap between what sellers wanted to for the property, still having 2021 prices in their mind, and what buyers were willing to pay. So could you tell our listeners a little bit how you were approaching that property in that environment?
Yes, yes. So you're absolutely right. When SL Taylor was started in 2016, there was quite a few um, Class B and C properties that were available. And the key to that at that time was that you could finance them up to, let's say, 65 to 80%, depending on which tool you were going to use, whether it was a bank loan or an agency loan or even bridge debt financing. There were more options because the interest rate was lower. At that time, it was probably less than 5, maybe, if I
Yeah,
recall right. And so when we did some acquisitions, the interest rate was very favorable, and we had options of how to put leverage on them. So as we moved through and multifamily kind of became the golden child in during the pandemic, 2021, 22, cap rates were compressed and prices went up, and a lot of people got out of the market, or they got into the market when the interest rate was really low, and then they were in a situation where they probably needed to sell. So it was a good time to sell because people were working from home. They were expanding their spaces within their home so they could work. Sometimes there was one, sometimes there were two people in the home working. And so they needed more room sometimes to sit at home and work during the pandemic. So there was a lot of movement during the pandemic of multifamily. And then in 2022, the interest rates started to climb maybe second quarter, end of first quarter 2022, the interest rates started to climb, and they went fast and hard up. And that was the response to our economy coming, I guess, out of the pandemic. So we continued to look at deals through 2022 and 2023. And the key to those deals were that you needed to go in understanding that you probably couldn't leverage them as much as you could in the past. We were seeing anywhere from 40 to 56% leverage availability on our loans, and which means that you have to go raise more money to get those deals closed. And that is, you can do it a couple of different ways. You can have someone of high net worth, or you can have a family office that is your kind of go-to person, or you can raise it through friends and family, or you can raise it just through commercial real estate colleagues. And so the work that you put into actually getting the deal closed is significant compared to the past. And sometimes it's successful and sometimes it's not. But our platform, it's not a large amount of money that you have to invest in, which also makes it a little bit more difficult because you need more people to actually get the deal closed. And then the other component of that, with the higher interest rates, as you're willing to get the deal closed, you are required to work a little faster. If the tenants aren't ready to move or their lease hasn't ended, you have to decide whether you're going to put in place, roll them out quicker, or let it naturally end at the term of their lease. So the sooner you get in, the sooner you do your improvements, the sooner you're able to raise the rents to the market rates, and instill some of the products such as utilities that you can bill back, do some improvements to the property, make it look better, and like I said, raise the rents to kind of market standards. Um, you just have to move more significantly to get through that deal.
Yeah, absolutely. So, was that a deal that was a broker listing, or was it directly with the seller that you found the deal?
We found both. We found brokers that wanted to continue to work with us and brought us deals. Um, a lot of them, it was hard to get information because the seller was kind of throwing it out there as, hey, go see what this thing is worth, and not really give them a full listing, not really give them all of the information you need to underwrite it properly. And so that became more difficult in gathering that information and getting it into our system for underwriting. Some of them were full marketing package information was available, but the seller's expectation hadn't adjusted to the higher interest rates or the change in cap rates. They wanted cap rates as they had acquired the property a handful of years before, and that had significantly shifted in the market.
Mhm. Yeah, I think that's what we have been generally been seeing, right?
Yes.
The sellers that are, or property owners that are prospective sellers that do not have to sell, that probably wait on the sidelines, hoping that cap rates come back down with interest rates. Whether that will happen or not, who knows? But at least that's they are certainly not eager to sell right now. So the tendency is the ones that are willing to come to the market have a so-called capital event that you're facing. Either they have to sell or they have to refinance, and whether it's a
Hmm.
refinance or a sell, they have to face the reality that the valuation is lower, right? Even with the
Yes.
refinance. And so very often, rather than attempting to refinance, having to bring additional equity to the table to achieve that refinance, sometimes the sale is still a better option for them. And I think these are the deals that ultimately then also trade. So how were you able to win that particular deal in Dallas over the competition?
Most of the time, we had to use a bridge financing tool. And the bridge financing is actually a higher interest rate, but it gives you the freedom to typically take cash out and improve the property quickly. And then you would have to set it up to refinance into a longer term product, whether that was agency debt. You could still get agency debt at a lower rate, but you did have to raise more money. So if you go into the acquisition knowing that, and you're prepared for it, you could probably still pencil the deal. But everything had shifted. Everything had shifted. A lot of the deals that we looked at in late 2022 and through like mid 2023 never actually traded. And now, as we sit second quarter 2024, I am seeing a lot of those deals come back on the market. Some of them at the same price, some actually price increase. And the economists and the bankers and the colleagues that I spoke to and the educational platforms that I went to and listened to them talk in 2023 was that there were so many loans coming due for renewal because they had had interest rate caps on them. Instead of them selling those properties, the bank ultimately refinanced them. And I don't know the situation of how the bank refinanced them. I don't know if they did it at the same rate. They couldn't do it at the same rate because the bank couldn't afford that. But somehow the dynamics of the deal had changed. And so a lot of those properties did not transact from my
Yeah,
experience.
yeah.
Hmm.
Uh, I would say a majority of those obviously were bridge loans that were taken out 2021 to mid
Hmm.
2022. Uh, I would say it's probably not really a refinance. Some of them may have been refinanced, but in most instances it's just an extension
Hmm.
of the loan. Sometimes lenders were willing to reduce the rate, at least temporarily, maybe to
Hmm.
move some of the payment to the back end, so that it accrues, but it's not a current pay. So some lenders have been pretty flexible with
Hmm.
these so-called loan modifications and extensions. The problem is that everyone hoped that interest rates would come down by now, and so it was really that kicking that can down the road. And now we are
Exactly.
1 year later, and nothing really has changed, right?
Hmm.
Uh, and Rents in most markets have been flat, right? So there have been some positive developments, maybe that in some submarkets rents have slightly moved up, but overall, right, rents have been
Right.
flat, even have come
Rents
down.
have been rents have been flat. I believe in 2020 or 2021, there was the Dallas rent increase was in the mid-teens,
Yeah,
which was unprecedented. And now they are flat, if at all, uh, possibly moving up slightly. But the loan modifications that I saw in our personal homes, the offers that came in the mail during the pandemic, same product, right? Defer your payment, put it on the end, and I'm that's probably a good tool for some owners to do it in their commercial situation and put it on the end. But I think it's difficult to make the property cash flow, continue to make those payments, knowing that there's going to be that additional lump sum due at the end of the loan or when you sell.
yeah, yes, definitely. And
Mhm.
obviously, these loans now usually they extend for a year, right?
Mhm.
So now the new maturity is coming up. Maybe they will be able to extend for yet another year. And we certainly have seen quite a bit of volume that has been extended last year, that was supposed to mature last year. And
Mhm.
my suspicion is there will be, again, another round of extensions to next year. But at that point, there will unlikely be that many extensions left, because that's where ultimately all the lenders say, look, now we need to have a solution. Uh, Now, it surprises me that you said that some of these deals actually have come to market above of what they were at a year ago. Uh,
Mhm.
so I would say uh, everyone can ask whatever they want, right?
Mhm.
But when we look at what actually trades compared to the so-called whisper price or asking price, very often we see these deals trading at 10 to 20% below the ask.
Mhm.
So maybe it's just now a sign of the times that everyone just comes out with a whisper price that is everyone knows is completely unrealistic, but they just
Mhm.
toss the number out, and everyone accepts that ultimately the deal trades at 80% of that, right?
The ones I did see trade were at a lower rate. The ones that I saw come out that were at a higher sales price, it was, you look at the marketing material and you think, is that a typo? And then you go back and look at the due diligence package that you received the year before. It's like, that's not a typo. So then, if you're willing to look at the deal, you dig into, well, maybe they had some rent increases, maybe they did some of the improvements that we had intended to do, and now it does generate more income. But yeah, I was surprised myself to see some of those sales prices come across my desk.
Yeah, yeah. I mean, there are certainly some exceptions, right, where they
Mhm.
truly were able to do more value add and the NOI increase significantly. In those instances, it may make sense to ask for more. Uh, but I think it's only, we have never seen that over the last 10 years where you will be able to come out with a whisper price and then the prospective buyer being comfortable to come in at 10 to 20% off that whisper price as a LOI
Mhm.
without the broker telling them not to even to bother about it, right? So it's
Mhm.
only the situation has changed dramatically. So I wouldn't say that it's truly a buyer's market, right? Because there is just not enough deal volume that comes to market. But as a buyer, if you have a strong sponsorship group and you have the
Mhm.
financing in place, you certainly can come up with terms and conditions that are much more to your advantage than it was just a year or 2 years ago.
Yes. Another thing I've been seeing is people closing cash and then later refinancing. If they have the strong sponsorship or they have cash, and then you go ahead and use it to get the price that they want and close quickly, and then know that even at the lower amount prior to increasing the rents, they could probably refinance at a later date. But I've seen that strategy as well.
Yeah, yeah. So now a lot of people will say don't do bridge loans, right? Because everyone got burned, or many got burned in 2021 and 2022 with bridge loans. And as a result, now everyone says, oh, don't do bridge loans, only go with fixed rate loans. But you mentioned that for your recent acquisitions, you did a bridge loan, right?
Well, you have to have your strategy in place. I think that if you look at a bridge loan as your last option, it probably won't work. If you are, working crazily to get a deal closed, and okay, fine, I just don't want to lose my earnest money, or I just want this deal to close, it is one option. But if you don't understand the back end, you don't understand that you need to get out, maybe not as quickly as you got in, but you have a very limited time to get out to still make it pencil. It's a tool. Not recommended for majority of deals, but it is a possibility to use that tool
Yeah.
to get through an acquisition.
Yeah, you make an excellent point here, right? And I say that all the time, right? So one should not just toss down now everything that has a floating rate or has a bridge loan name attached to it. It's really a tool that should be used for the right
Hmm.
uh, acquisition. Now, when we look back into 2021 to mid 2022, what we have seen is that a lot of deals were done with bridge loans strictly to increase the leverage, even though these deals would have easily qualified for an agency loan because they were stabilized properties. But for an agency loan, they would have qualified for 55 LTV,
Hmm.
and everyone wanted 75 to 80% LTV, right? So
Hmm.
that is clearly not the reason why you should do it, right?
Right.
Without having a true value add play, right? And I think that was the problem back then. Everyone called it a value add, but in reality, very often these properties didn't have that much of a value add opportunity to
Hmm.
begin with. Right?
We also saw some deals come to us from people that had gotten in the market in 2021, assuming that they could do it like a home, kind of fix and flip. And they had had great success doing it with homes or duplexes. And then in their mind, they thought, well, I'll just move on to commercial. And so they jumped into a much larger property and then got in and realized it's just not that easy as a duplex, because you've got a lot more tenants, you need the income, you can't get in and get out as quickly. And so that was I believe that happened as well. People got in because interest rates were low. It was a hot market. They maybe didn't have the experience that some other commercial real estate professionals had, and just jumped in and then kind of freaked out. I need out. I need out quick.
Yeah, yeah, it's an excellent point, right? So that actually even happened with multifamily investors that have already done this in a few years before,
Hmm.
particularly to they bought in 2019 and they were able to flip it in 2021 for a massive profit because, again, you mentioned, right, double digit rent growth, cap rates compressing, so naturally everyone could flip these
Hmm.
properties. Initially they had a, a timetable of 5 years of a whole period, and then we're able to flip it within a year to year and a half for a massive profit. So a lot
Hmm.
of these buyers thought, well, we did it, so we can continue it, right?
Hmm.
And obviously, everyone now got burned who had that play in mind, because obviously cap rates moved up, values came down, rent stayed flat. So none of what worked excellent between 2019 to 2021, it went the opposite, right?
I feel
Uh,
like if you're in the business long enough, and I've been in the business, I'm working on my third decade, um, you really get the understanding how cyclical real estate is, commercial real estate, and I suppose personal real estate as well. Um, but that there's a time to get in and there's a time to get out, and then there's kind of a flushing period when it's time to get out and people can't get out or they're forced to get out. That's when a lot of the inexperience or lack of the proper sponsor or cash, backup cash, they get out of the business. And so I've seen that now a couple times in my 30 years. And again, I feel like this just went full circle again.
Yep, definitely. Right. So the advantage for those of us who stick to it, it creates more opportunities, right?
Mm-hmm.
Uh,
Right.
when everyone rushes in, it gets very hard. When a lot of the people drop out, then it creates more opportunities for those that are still around.
Mm-hmm. And the ones that are still around, that have been around, they realize that's their time to get in when
That's
everyone's
right.
getting out.
Yeah, very good. Uh,
Yes,
why don't you tell us a little bit more about Crew and what that
awesome.
organization is about?
I would love to tell you more about Crew. So Crew is stands for Commercial Real Estate Women, and Crew Dallas has a chapter that was formed approximately 45 years ago, and we are part of a federation of 81 chapters in 8 countries, I believe, and there's 14,000 members worldwide. The Crew Dallas chapter has about 400. We vacillate between 400, 425, 450, somewhere in there. Sometimes we go less than 400, but it is for commercial real estate women only. And we have a nice balance of all different styles of commercial real estate, all different sectors, and all many different levels of tenure in the business. If you've been in the business a short time, there's groups and for that. And if you've been in the business a long time, there are groups for that. The Federation hosts leadership summits and annual conventions where we get together, and it's very much a learning platform, networking platform. And the moniker for Crew Dallas this year is Meet, Learn, Help. And we meet people, we do business together, we learn what's going on in our marketplace, we learn about new products, we learn about new trends, and then almost all the chapters have a component of philanthropic arm. Crew Dallas has what we call Crew in the Community, and it is a 501c3. And we have events, both our annual Crew Classic golf tournament in October. We also have what's called the Impact Luncheon in May. Last year we had Darren Woodson and Meredith Land speak to us. This year we have an Olympic gymnast coming to visit, Carly Pattison. And it's a fundraiser for us. And through 2021, we had given back around $3.7 million back into our community to help raise women up in what we do, to help them educationally, to get them in a different economic position that they had been in the past. And so there were a lot of organizations that were assisted in the past. And then in 2022, the board made a decision to start saving money for its own education fund. So we are about to roll out the Crew in the Community Education Fund, which is an attempt to keep our funds local to help DISD students. There's 6 counties in Dallas that if you are graduating from high school within one of those counties, you qualify for up to $5,000 scholarship if you're going to study commercial real estate. And opposite, if you are from somewhere else and you're coming into Texas to study commercial real estate in one of those counties, you also qualify. And our goal is to help DISD students, underprivileged and they don't have to be underprivileged, but it is a needs-based, not a merit-based scholarship, and help them move through, maybe what's difficult stages of getting into school. It's also for undergrad, trade school, community colleges, and it's not limited to undergrad or graduate school. So we're trying to open it up to more students. This is our first year of doing this. Applications are open now through our website and through the Communities Foundation of Texas, and the deadline to apply is May 15th. So to date, we've raised somewhere around $150,000 that's going to go into the Community Foundations of Texas Fund, and we will dole out these scholarships, $2,500 to a max of $5,000. So we're super excited to do that. It's been a leadership journey for me. I've been on the Cru Dallas board this is my 4th year, I believe, and I'm president this year. I'll be past president next year. And during our last year, we expanded the board. So now we have 13 members on our board. We have 13 members on Cru and the community board, and wanted to make more seats at the table for younger professionals. And so opened it up, changed the requirements a little bit to open it up to others to learn board service, servant leadership. What is it like to serve on a board? What is it like to work on behalf of a volunteer organization? And it has been a wonderful journey. It led me also to the opportunity to sit on some of the federation's planning committees and some leadership certificates that I've completed. So it's a great, great tool for women in commercial real estate.
Yep, that's only the case, and great to hear all the charity work that you're doing. My wife is a member of Cru, and she loves it.
Yes.
Right, and
Yes.
I would suggest that any woman in commercial real estate, whether you're in Dallas or any other part of the country, only find out where your local, I do know whether you call it chapter or federation, but it doesn't really matter what it's
Chapter.
called. Just
Dallas.
find your local chapter and sign up, because it's still amazing, right? When you're at large commercial real estate events like an NMHC or some of the others, it's still a sea of men, right?
Yes.
These
Yes.
events, and it's
Absolutely.
I think Cru helps really to get women in commercial real estate more of a voice, and it helps you to grow in that world, right? So it's
Absolutely.
definitely every woman should be part of this, right?
Yes.
So,
And we started in 2022 a Cru Dallas Leadership Institute, which is in conjunction with SMU Cox School of Business. And it's a 1-year program. We offer it every other year as well. So it's another way, if you're new in the business or not new in the business, there's leadership content, growth content that you can come in and learn. And that's our whole goal, is to have a platform for women to learn, network, do business together. And you're right, most meetings we go to is a sea of men. Men are allowed to be in our chapter. I think some of them are intimidated to join, but they are allowed. So we don't have very many men that are members of Cru Dallas, but they are certainly allowed to apply.
very good. So thanks for having joined us today, Sandra. So how can our listeners reach out to you?
You can reach me through my company, SL Taylor, Sandra at sl-taylor.com. You can also find me on the Cru Network website. You can find me on the Cru Dallas website under Board of Directors. I am there. There's a phone number to reach out to me. I'd mention one last thing, that part of the Federation, there is a personal investment platform for learning, and that is one thing that I help manage with Crew Network. We have quarterly calls, and it's again a way for women to learn about personal investing. And I think this next time we're going to talk about how to getting your deal out, how to marketing a potential property, and how to put some financing on it. And it's not a platform to showcase my deals. It's more that you can learn about personal investing tools. So either
Oh,
way, come check us out. And thank you, Anton, for having me. This was
yeah,
fun.
it was great to have you on. Thanks again, Sandra.
All right. Thank you.
Yeah. Bye bye.
Okay. Bye.